Most people don't lose money investing because they're unlucky. They lose money because they misunderstand how investing actually works. And the problem is, they usually don't realize it until the money is already gone. What makes this even worse is that most investors don't fail in dramatic ways. They don't lose everything overnight. They lose slowly, quietly, repeatedly. A bad decision here, an emotional reaction there, a little impatience, a little overconfidence. And before they know it, years of effort turn into disappointment. What's interesting is that many of these people are not careless. They're not lazy. They're not stupid. In fact, some of them are very smart. So why does this keep happening? To understand that, we have to look beyond charts, markets, and headlines, and look at human behavior. Because investing isn't just about money, it's about psychology, and that's where most people lose. Here's something most investors never think about. The market doesn't reward intelligence, it rewards discipline, and discipline is rare. When people first start investing, they usually feel optimistic. They've read a few articles, watched a few videos, maybe seen someone else make money. Everything feels possible. But optimism can be dangerous, because optimism makes people believe the future will be simple, that gains will come easily, that losses won't happen to them. And that belief shapes their decisions in ways they don't even notice. One of the biggest reasons people lose money is emotion. Not logic, not lack of information, emotion. When prices rise, people feel excitement. They feel left out if they're not participating. They feel pressure to act. So they buy, often late. When prices fall, fear takes over. Doubt replaces confidence. And suddenly, the same investment that felt safe feels unbearable. So they sell, often at the worst time. This cycle repeats again and again. Buy high because of excitement, sell low because of fear. It sounds obvious when explained, yet it happens constantly, even to people who know better. The problem is that our brains are not wired for investing. They are wired for survival. In the past, reacting quickly to danger kept humans alive. Today, reacting quickly to market movements destroys portfolios. The market rewards patience, but patience feels uncomfortable. Doing nothing feels wrong. Waiting feels risky. So people act, not because it's smart, but because it feels safer than waiting. And that instinct costs them money. Another common mistake is following the crowd. Humans are social by nature. We look to others for cues, especially in uncertain situations. When everyone is talking about an investment, it feels validated, it feels real, it feels safe. But by the time something becomes popular, most of the opportunity is already gone. What people don't realize is that markets move before stories spread. By the time the story reaches everyone, the smart money has often already moved on. So the crowd enters late and exits early. Again, the result is loss. There's also the illusion of control. Many investors believe that with enough research they can predict outcomes. They study charts, read forecasts, analyze trends, and while research is important, it creates a false sense of certainty. Markets are influenced by countless factors, many of which are unpredictable. Even professionals are often wrong. But when people believe they have control, they take risks they don't fully understand. They concentrate too much, they overtrade, they ignore warning signs. And when things go wrong, the losses are larger than expected. Another reason people lose money is impatience. Real investing takes time, years, not weeks. But modern culture promotes speed, fast results, quick wins. Social media amplifies this by showing success without context. People see gains, not the losses behind them, outcomes, not the process. So when progress feels slow, people assume something is wrong. They switch strategies, chase new ideas, abandon plans before they have time to work. This constant switching creates friction, and friction destroys returns. Many investors also confuse luck with skill. A few early wins can feel validating. They build confidence, sometimes too much confidence. But short-term success doesn't mean a strategy is sound. It might just mean conditions were favorable. When the environment changes, luck disappears, and reality arrives. This is often when losses happen, and because the confidence was built on fragile foundations, the emotional impact is severe. There's another problem that's rarely discussed. Most people start investing without a clear understanding of risk. They focus on potential rewards, they imagine gains, they visualize success, but they don't fully consider downside. They don't ask, what happens if this goes wrong? How much can I lose? How will I react emotionally? Without these answers, even small losses can trigger bad decisions. What makes all of this worse is that investing is lonely. When things go well, people talk. When things go badly, they stay silent, so failures feel personal, isolating. People assume they're the problem, not realizing how common these mistakes are. This isolation leads to emotional decisions, which leads to more losses. Here's the quiet truth most people don't hear early enough. Successful investing is boring. It's repetitive, unexciting, predictable, and that's why most people don't stick with it. They crave stimulation, action, confirmation, but the market rewards the opposite. The investors who succeed long-term are not always the smartest, they're the most consistent. They understand their own behavior, they accept uncertainty, they respect risk. They don't try to outsmart the market, they try to avoid self-sabotage, and that mindset makes all the difference. If there's one lesson that matters more than any strategy, it's this. Most investment losses are not caused by the market, they're caused by decisions people make because of the market. Fear, greed, impatience, overconfidence. These forces don't disappear, but they can be managed. Understanding why people lose money is more important than knowing how to make it. Because once you understand the traps, you stop falling into them. And when that happens, investing becomes less stressful, less emotional, and far more sustainable. Most people don't fail because they didn't know enough. They fail because they didn't understand themselves. And that's the real costliest mistake.